10 indicators on your chart, still losing money. The chart only ever needed 2. Here's the framework.
Look at any forex chart and the first thing you'll see is candles. Green, red, body, wick. Each candle is 4 numbers compressed into one symbol. Open, high, low, close. The body spans the distance between where price started the period and where it finished. The wicks are the extremes it touched in between. Green means it closed higher than it opened. Red means lower. That's it. That's the entire vocabulary of the chart. But the shape of the candle tells you a story the numbers alone don't. A candle with a tiny body and a long wick, what traders call a pin bar, means the market tried to go somewhere, ran into a wall, and got dragged back to where it started. At a key price level, that's a rejection. A candle with a huge body and almost no wick, a marubozu, means the move ran without resistance. That's momentum. Same 4 numbers, completely different story. Now, the resolution you read these candles at matters more than the broker you trade with. Every candle covers a period of time. M1 is 1 minute per candle. M5 is 5. H1 is 1 hour. D1 is 1 day. Most beginners default to the shortest time frames they can find, and most beginners lose. Here's the mechanism. On a 1-minute chart, you'll see 10 setups in a session. Sounds great, except every trade pays the spread. And on a typical Euro-US dollar spread of 1 pip, you're handing the broker a pip 10 times before you've earned anything. The math doesn't work. H1 and H4 are the retail sweet spot. Slow enough that you have time to think, fast enough that a trade plays out in days. And the reason that sweet spot works isn't actually the time frame itself. We'll come back to that. Read the same pair on 3 time frames at once. The daily chart tells you the trend regime, up, down, or range. The 4-hour shows the structure within that trend. The 1-hour is where you actually pull the trigger. Set up on the higher time frame, execute on the lower. That single rule keeps you out of half the trades that destroy beginner accounts. The ones where you're scalping a 1-hour bounce inside a daily downtrend, fighting a tide you never saw. Then comes the single most useful concept on any chart, support and resistance. Support is a horizontal price where the market has stopped falling and reversed up. Resistance is the mirror, where price stops climbing and rolls back down. The mechanism is straightforward. Big institutional orders sit at memorable price levels, round numbers like 1.0800 or 1.1000 on Euro-US dollar, prior session highs, weekly opens. When price hits those, real money executes and the tape reacts. But here's the part most beginners get wrong. These are not exact prices. They're zones, 5 to 15 pips wide on the majors, wider on exotics. Draw rectangles, not lines. A single pixel line looks precise, but it's a trap. You'll get stopped out by 4 pips and watch the trade work without you. 3 touches confirms a zone. 2 is a guess. 1 is noise. And when resistance breaks, it doesn't disappear, it flips. Old resistance becomes new support because the same orders that defended it from above now sit beneath it. That flip is one of the highest probability setups in retail trading. Trend lines work the same way, just diagonally. 3 swing lows in an uptrend, you've drawn a moving support level. 3 swing highs in a downtrend, you've drawn moving resistance. 2 touches isn't a trend line, it's 2 dots. You need 3. That brings us to indicators, and most of them are noise. Every oscillator you've ever heard of, MACD, stochastics, Bollinger Bands, is mathematically derived from price. They lag the thing they're supposed to predict. Stacking 5 of them on a chart isn't analysis, it's a confirmation bias machine. 2 indicators earn their space. The 200 EMA, an exponential moving average of the last 200 candles, weighted toward recent values. Above it, the market is in a bullish regime. Below it, bearish. Every institutional desk watches it, which is exactly why it works. It's a self-fulfilling level. And RSI, a 14-period oscillator bounded between 0 and 100. Above 70 is overbought. Below 30 is oversold. But the real signal isn't the line crossing 70, it's divergence. When price makes a new high but RSI doesn't, the move is losing fuel. That's the moment worth waiting for. 2 indicators. Delete the rest.
Same logic with patterns. Beginners memorize 30. Professionals use 5.
Double tops and double bottoms. 2 rejections at the same price. Clear entry, clear stop. Head and shoulders. 3 peaks, the middle one highest. Neckline break confirms the reversal. Flags and pennants. A short consolidation inside a trend. Breakout continues the move. Engulfing candles at support or resistance. 1 big bar swallowing the prior one. And inside bars, a small candle nested inside a bigger one. Breakout of that range is the trigger. None of them work standalone. All of them work in context. Here's what reading a chart actually looks like in practice. Euro-US dollar on the 4-hour. Price is trading above the 200 EMA. Bullish regime confirmed. You spot a rising trend line with 3 clean touches, and just above it, a prior resistance zone that's already flipped to support. Price pulls back into that zone. RSI is at 42, climbing out of 35. Exhaustion is clearing. Then a bullish pin bar prints right on the level. Long wick down, small body, close near the high. Entry at the candle close, stop below the wick. Target the prior swing high. Risk reward 1 to 2, or you pass on it. Most setups don't look like that. Most weeks you'll see 1, maybe 2 that do. Your job is to wait for them and ignore everything else. Which brings us to the part nobody wants to hear. A perfect setup still loses 30 to 40% of the time. A sloppy setup can still win. Charts don't make money. Discipline applied to charts makes money. Taking only the trades that match a written checklist, sizing positions so a losing streak can't wipe you out, and journaling every trade you take. Remember the H4 sweet spot from earlier? The reason it works isn't really the time frame, it's that H4 forces you to wait, and waiting is the only edge most retail traders can actually execute. 2 indicators, support and resistance as zones, 3 time frames, 5 patterns, 1 checklist. That's the entire framework. Everything else on your chart is decoration.
2 indicators, 3 time frames, 5 patterns, 1 checklist. The rest is declaration. Full breakdown linked in the description.